And she has a new playbook as a result. Gabriela Santos, global market strategist with JPMorgan Asset Management, joining me once again live. It's good to see you again.
Good to see you, Scott.
So you were with me right before Powell. Now, post-Powell, you say we got more than we bargained for. In what way?
So when I was there with you pre-Jackson Hole, we had a wish list of what we wanted to hear. We wanted a lot more visibility on what kind of data they're looking for, where they expect to take rates and for how long. But we actually thought it was very unlikely to hear anything about these short-term dynamics. Instead, we did hear a lot from Chair Powell, and the fact that he had such a short and direct speech, I think really forced investors to listen to what a lot of Fed members had already been saying for weeks. It's going to take a lot more softening in the inflation data to calm their fears down. It's going to take a lot more softening in the labor market data as well to get the Fed pivot back in play. And what that means is rates higher, closer to 4% by the end of the year, and staying there through 2023. And I think we're starting to price that in better, but we're not quite there yet.
Okay, so what does that higher for longer scenario mean for stocks? Can't be great.
So I think it means, first of all, higher real yields. Because remember, the first leg of the stock market rally during the midsummer night's dream there was related to the plunge in real yields from 0.9% mid-June to 0.1% in August. Now, we've unwound part of that. Real yields are back to 0.6%, but they're still too low. So that means what started to become a growth-led rally once again is starting to reverse course, but has further to fall from here. The other thing it means is investors have to take seriously the pricing of a mild recession next year. And that's what fueled the second leg of the rally in August, was this belief that maybe there was a path for a soft landing and there wasn't a need to price as much recession risk into multiples, earnings, and credit spreads. And we still need to unwind that optimism and better price in the economic risks as well.
Read your notes today in which you say don't give up on the traditional 60-40 portfolio, which has been especially tough, obviously, in the month of August in and of itself. Bonds down 3%, stocks down 4%. Why not give up on that?
So I would say for two major reasons. The first one is this encouraging upturn in the 40 part of the 60-40, or the core bonds part, which actually started to rally from mid-June to early August when yields were falling and there was still more of a recessionary concern. So bonds have started to act as a diversifier again when there is recession risk. So that's really good thing. And we want to continue adding duration, core bonds, as a hedge against that higher recession odd. The other reason to not give up on the 60-40 is just where valuations are today. They're so much better than they were on January 1st. Multiples are still lower, yields are higher, and that suggests much, much better returns ahead. In the past, we have had other moments where the 60-40 has been down over 10%. We've had, for example, 9 years where that's happened historically. The following 8 out of 9 years, the 60-40 was actually up the following year by an average 17%. So that's the kind of much better returns we expect if we zoom out the time horizon.
Let me ask you lastly about the Fed. Does his, I guess you call it unexpected directness, maybe that's how you come away from it thinking it was unexpectedly direct. Does that lessen the chance for a surprise in the upcoming meeting? Does it put 75 basis points on the table in a way that you didn't think existed pre-speech? How do you think about those two things?
So I don't think it changed the expectation for September too much. Going into Jackson Hole, there was already about a 68% probability of a 75 basis point hike. Markets were better priced in for that possibility, and it's still at about 70% today. We do think the odds of a 75 basis points are more likely than not, but will depend on the jobs data on Friday, as well as the August CPI data on September 13th. What I think it really changes is much more the outlook for rates in 2023, this expectation that we pivot from hikes to cuts so quickly. That's what's very welcomely being shaken by that speech that Powell gave. gave. Rate cuts have gotten pushed back a little bit, but they're still there in expectations for the back half of 2023. We'd like to see those push back further before we really feel comfortable adding risk here.
You and Loretta Mester both, because those were her comments today, too. Basically, don't even think about the cuts next year because we don't see it. Now, we'll see if they hold to that because maybe they can't.